Good afternoon. My name is Todd Ensign, and I am tax partner with the national accounting firm of Capon and Krause. And on behalf of American Anglican Council, I would like to welcome you today to the continuing three-part webinar series on ministers' tax issues. And back in October, we covered the basics of ministers' taxation, and today what we want to do is just cover the latest updates on the 1040 front, the personal tax side, and how those affect ministers. And on February 2nd, we're going to be providing you with a webinar on tax preparation tips and just some do's and don'ts. And so we're looking forward to that. We think that'll provide you with some valuable information before you file your personal tax returns for the year of 2011. And are we having fun yet? Boy, there has been a flurry of activity in 2011 and a lot of things going on, and we have a website that we can visit, that some software, and it gives you a complete list of all the goings on in Washington, and it is pages of possible legislation they might think about passing and legislation that passed. It's just really crazy, very difficult to keep up with. And as we're moving into an election year and with all the craziness going on, I thought it would be very appropriate for us today to start off with prayer. And as you know, the Lord asks us to pray for our elected officials. And so I thought it would be very appropriate to just whisper a prayer for them. So would you allow me to open us up in prayer today? Heavenly Father, we just thank you for your mercy and your grace. And we come to you today in the name of your Son, the Lord Jesus Christ. And thank you for such a beautiful day. Thank you for being able to talk about these things. And Lord, we just want to lift our president to you, our Senate, our Congress, our local elected officials, and pray that you would just give them wisdom, common sense, and good understanding. And we just pray that you would fill them with a fear of you, that they would have respect for what you want, and an understanding for you, what you want, and that you would just guide and direct their hearts. And we just ask this for your glory. And Lord, for all those that are listening today, I just pray that your blessing would be upon them, that you would encourage them and strengthen them and just help them. And as we talk through these legislative updates and the tax implications, that you would just give us wisdom and common sense. And so we thank you for that today, and we pray these things in the matchless name of Jesus. Amen. Well, again, welcome to the personal income tax update. And what we want you to take away today in your gift bag is we're going to talk about happenings on the Hill, things that have been going on in Washington and how it affects you. We're also going to talk about some fun facts, give you some key figures that will help you when filing your returns, and just some hidden treasures, some things to think about that possibly you might not have, and that might help you as well when you're considering your personal returns and looking into the future. And let's talk about happenings on the Hill. Boy, again, a flurry of activity, things just moving all over the place. We're moving into an election year, and there's going to be a lot going on. But I think what would be very helpful for us is to consider a history lesson, because as we look back into the past, that's going to help us understand what's coming up here in the future. And so let's revisit some legislation that was passed in prior years. We'll call this the first one EGTRA, 2001 Tax Act. It was passed under the Bush administration. We'll talk a little bit more in depth on these in just a second. Another tax act was passed in 2003 by the Bush administration. Another was passed in 2009 under the Obama administration. Those three drove a lot of the reason why the Tax Reform Act of 2010 was passed under Obama. And again, we'll talk a little bit more about those. But having an understanding of this history will help us to understand where we are today and what we can anticipate this year and into 2013 and forward. Let's jump into EGTRA. It's the 2001 Economic Growth and Tax Relief Reconciliation Act, again passed under Bush. That had a number of permanent provisions that were passed, but there were also some sunset provisions that were passed under that act that were set to expire at the end of 2010. Some of those provisions were favorable tax rates for individuals, lower tax rates. There was a marriage penalty relief that was passed for those that file married filing jointly, some education-related deductions. There was an itemized deduction limit for certain taxpayers that have an adjusted gross income over a certain amount, and that was eliminated, and the no phase-out of personal exemptions, again, for higher income tax bracket payers. And there were some alternative minimum tax, or AMT, exemptions that were increased that actually decreased the amount of income that was subject to alternative minimum tax under this tax act, and some credits as well. And there were a number of other provisions that were passed, but this is a good indication of the main ones that may affect you. But again, those were set to expire at the end of 2010 under the 2001 Act. Well, in 2003, the Jobs and Growth Tax Relief and Reconciliation Act also added some favorable long-term capital gain treatment, and at the max of 15% for qualifying long-term gain property, and also qualified dividends were taxed at 15%. Again, those were set to expire at the end of 2010. So we have the 2001 Act, the 2003, and now under Obama, the American Recovery and Reinvestment Act of 2009 was passed, and that temporarily boosted some credit incentives for higher education, and one of those is the American Opportunity Tax Credit that maybe a number of you availed yourself of with kids in college. Was a great deduction, and they also had rules for refundable child tax credits that were increased, and earned income tax credits were made available to more people, and those would have expired at the end of 2010 as well. So you have those three acts, 2001, 2003, 2009, with a lot of provisions expiring at the end of 2010. And if you'll remember, there was a lot of activity on the Hill, and the people in America were in the middle of a recession, and the people were saying, hey, if these aren't extended at the end of 2010, we're going to be paying some more tax. We can't afford it right now. And so under the pressure of the people, the Tax Relief Act of 2010 was passed under the Obama administration. It was passed by Congress on December 17th of 2010. And a lot of those provisions in those prior acts that were going to expire were extended. And a number of those that were extended just through 2011 were the expanded adoption credit. A higher credit was available. The alternative minimum tax exemption amounts were extended through 2011. The non-refundable tax credits offsetting AMT tax and the non-refundable tax credits offsetting regular tax were extended through 2011. And those are just a few of the ones that were extended through 2011. There is a huge list for 2011 and 12, 13, 14, going out multiple years of provisions that are going to be expiring, And it's just a long, long list. Also, some sunsets under this 2010 Tax Relief Act that were extended to the end of this year are the favorable tax rates, the lower rates. The highest rate is 35% for individuals right now. Well, it could jump up to 39.6 if this isn't extended. Reduced estate and trust tax rates, the increased standard deduction amounts for married filing jointly. The itemized deduction limit is going to come back in after 2012. Personal exemptions can be phased out if you exceed, could have under the old law been phased out if you exceeded a certain adjusted gross income level. Well, at the end of 2012, that's going to come back into play. And the reduced capital gains and qualified dividend tax rates are set to go up at the end of 2012. Some very, very important decisions are going to be made, and that's capital gains is always a big one. Some other extensions to the end of 2012, the child tax credit going from $500 up to $1,000. It'll go back down to $500 after 2012. The earned income tax credit will be changing. Dependent care credit will be decreasing. Some education-related incentives are going to go off the table, and all these are set to expire again at the end of this year. There was one stimulus incentive passed under that 2010 Tax Relief Act that affected 2011, and as you know, that was the 2% reduction in the Social Security tax rate to employees and the self-employed. And as you know, the FICA tax rate is 7.65%. That's broken down into two taxes, one Social Security at 6.2%, the other is Medicare at 1.45%. Well, that 6.2% Social Security tax was reduced to 4.2% all of 2011. And so that was great. We were excited about that, a 2% increase in pay, and will that be continued? Well, questions abound. And we just have a lot of questions whether or not these provisions that are expiring in 2012 are going to be extended or made permanent, whether the ones that expired at the end of 2011 are going to be retroactively reinstated. A lot of questions out there, and we just don't know what's going to happen. It makes it very difficult to plan from a tax perspective. For estate planning purposes, very difficult to plan as well. And so just a lot of questions. But one was answered at the end, right at the end of 2011 or maybe early 2012, but the stimulus incentive, that 2% reduction for 2011, was it continued? Yes, but only to the end of February of this year. And so if it's not extended further, on March 1st, we're all going back to the 7.65% being withheld from our paycheck for FICA purposes, or ministers are going to be paying the entire 7.65% from March on. And again, if it's not extended, there are going to be a lot of complications when filing your tax returns in 2013 for 2012. Some calculations you're going to have to work through, and it's just going to make things a mess if they don't extend it. So something to look at and consider. Watch that. I don't know if they're going to change it or not, but they may. So keep a lookout. Let's talk about some things that have expired. At the end of 2010, there was a Making Work Pay credit. It was the $800 that you got. A lot of you would get when you file your return, and that's no longer available for 2011. Things that are expiring at the end of 2011, that means you can use them when filing 2011's return, but not for 2012. There's an above-the-line deduction on page 1 of your Form 1040 for qualified tuition and related expenses up to $4,000 that you could deduct. Well, at the end of in 2012, again filing for 2013, that's going away. The $250 deduction for certain elementary and secondary school teachers that they could claim for education-related expenses is off the table in 2012. You know, the itemized, of those that itemized their deductions, the state and local sales tax option to be able to deduct that, that's going to be gone in 2012, and mortgage insurance premiums that were qualified as mortgage interest will no longer be able to be deducted in 2012 and forward. And some non-refundable personal tax credits are expiring as well. Again, continuing what's expired at 12/31, there's an exclusion of 100% of gain on certain small business stock. Not sure that applies to many people, but that's expiring. And there was a really neat opportunity for individuals over 70 and a half to be able to give to charity out of their IRAs without it being taxable income when they distributed it to the charity, up to $100,000. Well, that is no longer available after 2011. The adoption credit is going to be reduced. You can see the amounts. It's going down to $12,650 in 2012. Alternative minimum tax. Now, this is a big one, and there are reduced exemption amounts. So that means if you have tax alternative minimum taxable income of a certain amount, you were able to take an exclusion from income. It started at around $72,000, and there were some other calculations you had to go through, but that is dropping to $45,000, I believe, at the end of 2012, and that's going to can put a lot of people into being subject to alternative minimum tax. That's a tax increase, and that one is going to be hotly contested, so keep an eye out for that one. Also, some personal non-refundable tax credits will not be able to reduce the alternative minimum tax. So a lot of things happening there. What's happening that's new in 2012? Well, here's one that may not affect a lot of people, but for the people it does affect, they better be aware of it, and they better be in compliance because it is very important. Let's talk about foreign reporting of assets. As most of you are aware, there's a form. It's called the FBAR form. It's form TDF 90-22.1. If you had a signature authority over a foreign bank account or ownership in a foreign bank account, and during the year it was over $10,000 in value, you were required to file Form TDF 90-22.1 by June 30th of the following year. Well, there's a new reporting requirement, and U.S. taxpayers with specified foreign financial assets, and you'll have to drill down into Code Section 6038D, that if they have specified foreign assets, and if you're single and it's greater than $50,000 at the end of the year or more than $75,000 during the year, and for married filing jointly, it's $100,000 at the end of the year or exceeding $150,000 during the year. Excuse me. If that applies, you are required to file Form 8938, Statement of Specified Foreign Assets. It's filed with your personal income tax return. It does not replace the TDF 90-22.1. And here's the kicker. There are major penalties for not filing if you're required to do so. I mean major penalties. And so you've got to watch that. If you or anybody you know might be required to file this form, have them read the instructions to Form 8938, found at www.irs.gov, and seek tax counsel consideration, because this is a new change and very, very important, again, for those who qualify. What else is new? Your W-2, maybe, but there's loads of confusion on this. A lot of people thinking that, hey, I'm going to have something new that's going to be included on my W-2 and it's going to be subject to income tax. And this is for 2012 W-2s that are filed in 2013. And what the employer is going to have to do is include in box 12 of the W-2 under code DDD, they're going to have to report the health coverage that they pay on your behalf. And for instance, if they're paying part or all of your health insurance premiums, then it would go on W-2 in box 12 with a code of DD. But it's not taxable. Okay, it's not taxable, and that's where the confusion was coming in. Individuals thought, well, I'm going to have to include more on my W-2. It's going to be taxable, but that's not the case. It's just for information reporting purposes only, and only employers with more than 250 W-2s are going to be required to file this at this point. Now, the IRS may reduce those limitations, but at this point, it's only with those with greater than 250 employees, and so a lot of individuals are not going to be subject to this. It is voluntary, though, and employers can do it voluntarily if they wish. All right, so let's move on, and let's talk about churches and what's happening with churches in this changing world that we're in, and how it might filter down and affect ministers. I think it's very important to be aware of the changes that are going on. And let's talk about Senator Grassley and an investigation that he started. And there's also the ECFA Commission. It's called the Evangelical Council of Financial Accountability. The ECFA organization is a monitoring organization, an accountability organization for certain churches, missionary organizations, etc., in the evangelical world that are required, if they join ECFA, to have audited financial statements. And it's just an accountability that's very, very helpful, been great for our industry and our church world and the nonprofit world. But Senator Grassley started an investigation, and he investigated 6 churches, televised evangelists operating as churches. It was a 3-year process, and of those 6, 1 fully responded, and not only responded, but joined ECFA, and that was the Joyce Meyer Ministries. 1 responded fully, the World Healing Center under Benny Hinn, but 4 of those resisted with partial or no responses whatsoever. And you can see the 4 churches there that really didn't respond. And this is what the investigation found. There are some common traits of these churches. A lot of them had multiple companies, and many of those companies were not filing a Form 990. A Form 990 is an information return for a nonprofit organization, for instance, a missionary organization, colleges and universities. Certain colleges and universities have to file them, but churches are exempt from filing that form. But companies that are owned by a church or related to a church may not be exempt from filing the 990. Multiple expensive homes of leaders, multiple vehicles, and we're not just talking about, small vehicles. We're talking Rolls Royces, Bentleys, aircraft, common and often plural. And employment of relatives for chief executive officers for high salaries, board-controlled family by family members, and that's not a positive thing in the nonprofit realm. And so just of a lot of perceived, I'll call it perceived, I don't know if you want to call it abuses, but a perceived extensive compensation and benefits, and are they being reported properly, and just not a real being able to look into a church and see what's going on within the organization. So with that in mind, Senator Grassley asked ECFA to address these issues that were raised in his investigation. Is there accountability that churches should be following? Should churches, for instance, have to file the Form 990 as other nonprofit organizations do? And let me just tell you a little bit about the 990. We do hundreds of those for organizations during the year. And the 990 reveals compensation for officers and directors and key employees and highest compensated employees. It reveals related parties and transactions that go on between related parties. So you can see if a president of an organization gets compensation from the reporting organization, but they're related to another nonprofit, that organization that's filing the 990 has to report the compensation from the related organization. And board governance policies and all these internal criteria are reported on the 990. And so the IRS and the public is getting a good view into these nonprofit organizations and helping them to understand what's going on within the organization. And churches don't have to follow that requirement. And so the ECFA, Senator Grassley asked ECFA to form the Commission on Accountability and Policy for Religious Organizations, and there are many issues to be addressed. And here's kind of a diagram. You see that commission, the big circle, and they're getting input from Grassley, from the Treasury, the IRS, panel of legal experts, on which our own tax counsel, John Butler, is on the panel, and a number of other areas. You can see they're getting a broad range of information coming into the commission. They're looking at these criteria and trying to develop and come up with suggestions that might help the community, the church community, to become more transparent, more accountable. And so it's a very, very delicate position that this commission is in, and a lot of implications that could come out of this for churches. Are they going to be required to file a Form 990 or some abridged form that's close to that would provide information, compensation, and et cetera for church leaders? And so just a lot of things that are questionable and coming through. So if you ever want to pray for the commission, that would be great, because I know that they would appreciate it. So keep our eye on that. 2 to 3 year time frame, with a year almost already passed. So it's they're working on it right now. Let's talk about the challenge to the minister's housing allowance. And I know all of you have heard something about that. Let's give you a good update on that. In 2009, the Freedom from Religion Foundation filed a case alleging that the housing allowance was unconstitutional. And in 2010, the district court who was hearing that said that the Freedom from Religion Foundation had standing. Now, I'm not an attorney, and I may not describe it very well, but the understanding of what standing is that the person or entity bringing the case would be affected by the outcome of the decision in that case. And since they're challenging the housing allowance, well, the Freedom from Religion Foundation is not an individual. They don't file an individual income tax return, and they're wouldn't have any effect on the organization whether or not the housing allowance was unconstitutional from an individual tax filing standpoint. But this district court said they had standing anyway. Well, in 2011, the Supreme Court was viewing a case and hearing a case, and they said that the organization bringing the suit did not have standing. And it was very similar in nature to this Freedom from Religion Foundation bringing this suit. And so the Freedom from Religion Foundation dropped the case because they knew if they took it to the Supreme Court, they would likely be ruled that they didn't have standing anyway, just a waste of time, so they dropped the case. So that's where we're standing. But what does this mean? The case applied to the exclusion from income tax from the minister's housing allowance. And Code Section 107 talks about the minister's housing allowance. And the thing about Code Section 107 is that it's very exclusive because it states that a minister of the gospel can exclude from income tax the housing allowance. It's the minister of the gospel that's very exclusive. And a question, that I have is, do others want a piece of that pie? Do other religions that are not considered ministers of the gospel want to have that available to them? I don't know. Do others just want to see it abolished? Is there an attack upon Christianity and our faith in this country, and where they just want to remove it because they don't think ministers of the gospel should have that benefit? I don't know. We'll see. So it would be very unlikely, I would think, that they would declare it unconstitutional. It would take quite a bit to get that done. But the other ones, wanting a piece of the pie or having it, I don't know. That might be something that others might consider. There was another case, a minister with 2 homes. I'm sure you've heard about that. Let's quickly talk about that. It was a Driscoll case, and a Minister Driscoll, he was a president of a parachurch organization. And it's very important that that was a parachurch organization, not a church. And he had a house in town and a house on the lake. And the IRS said that he did have a townhome and a lake home, so they concurred with him that he had 2 separate homes. And the interesting thing is that the IRS did not challenge his eligibility to claim a housing allowance to be treated as a qualifying minister and to be able to have a designated housing allowance. It's much more difficult in a parachurch organization to get that qualification as a minister. And but the IRS didn't challenge that. So this is what happened. The court ruled in favor of Driscoll, and the majority said that the IRS conceded 2 homes, and the law does not prohibit 2 homes. But they also said in their decision that the IRS shouldn't have conceded 2 homes, and they should have raised whether or not Reverend Driscoll was eligible to be a qualifying minister in the parachurch organization. And under the minority, they said that even though a statute doesn't prohibit 2 homes, it's nearly impossible to have 2 homes at the same time being your primary residence, and he didn't have 2 homes. So again, the IRS is never going to concede that a minister has 2 homes, so we can forget trying to do that. And the court case describes why it's nearly impossible to have 2 homes at the same time. And so, again, no ministers with 2 homes. Now, there are some possible exceptions, but it's not really 2 homes when you think about it. In Indiana, we have ministers, retired ministers, that will have a home in Indiana. They'll live in it for the first 6 months, and the last 6 months of wintertime, they'll go down to a home they own in Florida. And can you deduct the expenses from both homes? Well, you'd have to prorate it half the year to one and the other. But essentially, when they're doing that, it's like they're living in one home. So that's a possible exception, but a lot of finagling and working you have to do to see that that's done. But anyway, this was some really bad press for the housing allowance, especially when it's been under scrutiny and being attacked, and so it just wasn't a real good thing. But that should help you understand the information about the 2 homes. Other updates. quickly on the cell phones provided by employers. They passed some legislation, I believe last year or so ago, that delisted cell phones, so you didn't have to keep all the substantiation requirements, the arduous requirements that were probably not kept by many anyway. But then we were waiting on some rulings to come out to help us determine whether personal use of employer-provided cell phones was de minimis use. Well, they gave the information, and here it is. You do not have to tax employer-provided cell phones. So if you have a cell phone that your employer is providing you, it's not taxable compensation to you if it's provided to you substantially for business reasons. Very important. What's an example of business reasons? If you're a minister and your church provides you with a cell phone because you have to be available in case of emergencies for somebody in your flock, then that's a substantial business reasons. If you need to be able to be contacted when you're away in case of emergency, again, for something in your church, that's a substantial business reason. And there could be time zone differences, things you have to deal with customers, but not probably in your world so much. But so it has to have a substantial business reason. Now, if you're provided a cell phone for non-compensatory reasons, okay, simply because they want to increase your morale or they want to give you just a benefit for being an employee, but no real legitimate business purpose for having that phone, it's taxable compensation to you, okay? Employer-provided cell phones, again, the bottom line, personal use is de minimis if you, again, is provided for business purposes. It's very important for the employer to document the use and why it's being provided to an employee for business purposes, and then just enjoy your cell phone and the benefit that they're able to provide. Now, what if you're reimbursed by your employer for a cell phone you have personally? Is that taxable compensation to you? Well, if you are required by your employer to have a cell phone and the coverage that you have on your personal cell phone is reasonable based upon what you need for your employer, and the amount that you calculate is reasonable for the reimbursement, then it's not taxable to you. I would request employer documentation as to the reason why they're requiring you to have a cell phone. Also, document your coverage, that it's reasonable. And when the calculation is done, make sure it seems reasonable in all respects and it's in line with the business use that your employer is requiring. So some good news on the cell phone front. That's been a big question as we've gone. So in summary, it's been a busy year in 2011. It's going to be probably even busier in 2012. We had the Bush-Obama tax changes, 2001, 2003, 2009. And then they passed this act in 2012. Some of those provisions, in 2010, some of those provisions have expired. More are set to expire in 2012. Excuse me. Will there be changes before the election? There could be. Will there be changes after the election? I bet there will. So keep the light burning in the lighthouse. Keep a watch out. Keep watching this ECFA commission to see if there will be any changes to churches. And the housing allowance, is it going to be here to stay? We'll keep a watch on that. So my forecast is to get your coats on, get your hats on, buckle in those skis, and look for the flurries that are coming, because they're on the way. Excuse me, I have a little problem with my throat. let's talk some key tax figures. As you know, taxpayers can itemize their deductions or they can take a standard deduction, whichever is higher. For 2011, the standard deduction for married filing jointly is going to be $11,600, and it's bumping up to $11,900 for 2012. You can look through those figures and see which applies to you. But again, itemized deductions or the standard deduction, whichever is higher, and you can see the amounts there. The FICA rate, the Social Security portion is 5.65 well, the total FICA rate is 5.65 through February, bumps up to 7.65 beginning in March. The employer rate is unchanged, and that 6.2% of that 7.65% that is withheld from employees, once you reach $110,100 of wages during 2012, that tax will stop. So that has jumped up from $106,800 in the prior year. So lots of flurries ahead. We've been talking about Social Security income and whether or not that's going to be secured. Just again, a lot of flurry going on. The exemption deduction is going to move up to $3,800 from $3,700 for 2011. The annual gift tax exclusion of $13,000 is going to remain unchanged. And if anybody's claiming the foreign earned income exclusion for 2012, that's going to get close to $100,000 at 99. Excuse me. At again, at $99,100, up from $92,900 on the foreign earned income exclusion. I apologize for the slides doing that. Had some things pop up. Okay, for the business mileage rate, this is very important. It's going to be 55.5 cents for 2012. For 2011, for the first 6 months of the year, it's 51 cents. For the last half, it's 55.5 cents. So you're going to have some calculations if you claim mileage on your personal return. The moving mileage rate is going from 23.5 cents at the end of 2011 to 23 cents in 2012. Same for the medical. And the charitable mileage rate remains unchanged at 14 cents. And again, watch those July 1st rate changes for 2011 when filing your tax returns. Here are some other key figures. The max defined contribution plan limit jumps to $50,000 from $49,000. The salary reduction under the 401k and 403b jumps up to $17,000 in 2012, up from $16,500. If you're over 50, there's a catch-up provision of $5,500. There's no change on that. The IRA contribution limit's $5,000, no change. And if you're over 50 for the IRA, you can catch up $1,000, no change there. The high compensated employee is going to be $115,000, up from $110,000. Well, let's move now to some hidden treasure as we get into the last few minutes of our webinar today. This was presented in our last webinar, but I want to touch bases on it again, that reducing SECA income and SECA tax, you know, the housing allowance generally, if you haven't exempted out, is subject to SECA tax. Your W-2 is subject to SECA tax if you're a minister, a qualifying minister. And so, but UB can reduce SECA income and ultimately SECA tax. And what's UB? It's unreimbursed employee business expenses, and those expenses you claim must not be available for reimbursement by your employer. And if you have gross 2106 expenses, let's say you have mileage and you have a deduction of $2,000 of mileage that's not reimbursed by your employer and cannot be, then that $2,000 can be subtracted from your SECA income and reduce the amount that's subject to tax. And so that's a great benefit. Many ministers aren't aware of that, but please keep that in consideration. Very, very important, and we're going to hit on this over and over in the last few minutes. Document, document, document. Document your deductions. And so if you're claiming unreimbursed employee business expenses, document your deductions. For instance, if you claim mileage on Form 2106 and you deduct it on your personal tax return and the IRS comes and audits you, they may automatically deny that deduction until you prove to them that you drove those business miles with a, it doesn't have to be a business mileage log, but that would be great, is where you went, what the business purpose was, what the date was, who you visited. Just all that information being documented just saves you tons of time and heartache and possible taxes and penalties for when they deny a deduction. A few other things on some tax creep to avoid. Again, one thing we want to emphasize for ministers on the housing allowance. You can't exclude from housing allowance any more than the fair rental value plus utilities. And what happens with many ministers is the actual amount that they spend dictates how much they can exclude from income. So in 1 year, they may spend and exclude $30,000. And so they exclude it from income because they designated $40,000. The next year, let's say, they only spend $10,000. That means there's $20,000 that they excluded last year that they're not going to be able to exclude this year, and they get hit with this tax and they don't understand why. The amount a minister spends on housing-related expenses can directly affect how much tax they pay. So watch that from year to year, and if you're not spending as much as you did the prior year, anticipate possible higher tax amounts that you may owe or have to pay in. Cost of living increases. Did any of you get cost of living increases this year? A lot of churches are not giving them with the recession and things are very tight, but some of you, those that you do, if ever you get cost of living increases, have you compensated by increasing your withholding and or estimates that you pay in to help compensate for that tax increase that may occur when you file next year's tax returns? A lot of ministers are surprised there, so keep that in mind. What else can cause tax grief? If your child last year was 16 years old and you're claiming the child tax credit and they turn 17 in 2012, that credit is going to be gone when you file next year's tax return. That's $1,000. Keep that in mind. Exemptions may decrease. Your dependents may leave the nest and you can't claim them, and people are unaware and forget about that exemption deduction that you can claim. Education credits may disappear when they leave the nest and are no longer in school. Tax law changes that can affect your return that you weren't aware of. All of that can cause April 15th heartache, so please be aware of that. Let's talk about some housing allowance tips real quick. Is your housing allowance designated for 2012? It should be. You should designate that before the beginning of the year. We talked about that in our prior webcast, and that can be viewed, to my understanding, on the American Anglican Council website, so you can revisit that. Designate the housing allowance at the fair rental value plus utilities. That's the maximum you can exclude. What if you lived in a church-owned rectory? Should you designate a housing allowance? Absolutely. For the amounts that you think you might spend, and designate a little higher, because you can, even though you live in a church-owned rectory, still exclude expenses you pay on housing-related expenses. Document your expenses. We talked about that. Document. Home equity loans and refinancing. Very important you understand this area, because many ministers, if they have a home equity loan, will deduct all the interest related to that against the housing allowance. But if you take out a home equity loan, and let's say it's for $100,000 and $50,000 of it is to repair your home and upkeep your home, and the other $50,000 is help pay college tuition for one of your children, when you come to excluding the interest that you pay on that home equity line against your housing-related expenses, only half of that's going to be able to be excluded because the amount paid for college and tuition is not deductible because it was not spent on your home to upkeep, repair, etc. So watch that. And when you refinance your home, if you take money as above your earlier mortgage amount and you don't spend that on housing-related expenses, again, the same concept as applies. And did we say to document your expenses, keep records with your tax return, make sure that's done? And another common thing that we find with ministers is that if you're claiming a housing allowance and deducting housing-related expenses against that housing allowance and excluding from income, you cannot use your home as a business office of your home and claim the home office, business home office deduction. You're double deducting expenses, and that is a no-no. So keep watch on that. Again, keep records with your return. What if you are not required to file a return, or somebody you know? 5 good reasons to file anyway, even though you may not be required. If you have federal income tax withheld and you might be due a refund, maybe you might qualify for the earned income credit even though you're not required. You have a W-2, not required to file. Additional child tax credits may be available. The American Opportunity Credit for education expenses might be available. The adoption credit, that would be pretty straightforward if you did apply. And then there's another one. I'll let you look at that. If it applies to you, then you'll know. It's I'm not going to go into it. I really honestly don't know a lot about it. But if you applied to that, then that might be another reason to file a return. Again, keep watch and plan for expired tax provisions that have already expired. Look at those. Will any of those affect you in 2012? Provisions set to expire at the end of 2012. Again, some tax planning to consider. It's very difficult to do that because we don't know what the outcome is going to be yet in 2012. Watch for that March 1st 2% possible decrease in your pay. As a minister, you may not see that directly if you're not having amounts withheld, but you may have to plan for it, and you may have a 2% increase for 10 months out of the year when you file in 2013. Again, any tax planning, watch your withholding and estimates. Do you need to increase them, decrease them? And developing changes on the Hill with the election year are going to be very, very volatile, and I'm sure that they'll use it to their advantage to get votes and those types of things. Another thing that I would recommend is visiting our website at www.capeandkrause.com and move over to the tax section, and we have updates in there. We put out email alerts. We put out newsletters affecting businesses and individuals. Just a great place for you to go to look for information and changes that may affect you. Thoughts on tax filing in 2011. Did you know that Schedule D is just going to be kind of a pro forma form this year, and all your stock sale transactions are going to be reported on Form 8949, the new form, and that will be summarized just on Schedule D, so consider that. Also, you might consider direct deposit if you're getting a refund, and you can put that information on the return and they'll directly deposit it into your account much quicker to get the deposit. They'll do it sometimes within 10 to 14 days of filing the return. Consider electronic filing. If you don't file, consider a professional. They do file electronically. Also, the IRS, you can file electronically through the IRS. If your income limits, income is below a certain threshold, so check out the website there. The IRS is strongly encouraging individuals to electronically file. With all these changes that are going on, and with all the complications, and I'm telling you, it is complex. Do you need a tax professional? Many of you may not. Many of you may, but it just depends on your individual circumstances. But please consider a tax professional that is experienced in minister's tax, and it's very important. And when you get your return, whether you prepare it, whether you have a professional prepare it, review, review, review. Review the return. Ask questions and make sure you understand what's going on. Document, document, document. Oh, the IRS is just huge on documentation requirements. So please make sure you keep documentation. Keep it with your return. Again, like for instance, on housing-related expenses, keep a folder just for housing-related expenses. It shows your mortgage interest statement, your real estate tax paid, any improvements you make. Keep receipts and document. Keep a ledger of it so it's really buttoned down well. And so when you say, I claim $30,000 of housing-related expenses for the year, you have the documentation right in place in your file, and there's no question. Also, a very important thing to note, the due date this year for the 1040s is April 17th, which is a Tuesday. The 15th falls on a Sunday. The 16th is, I think, Emancipation Day or something like that, and it's a holiday only in, I think, Washington, D.C., and so there's no filing of returns on the 16th, so the due date this year is April 17th. Some treasure you might want to find. The IRS website really is a great place to find information. A plethora of information on www.irs.gov. There's an individual tab that you can click on that just lots of updates, information on how to choose preparers of income tax returns, what to do, what not to do, questions for ministers, just frequently asked questions on a lot of issues. And there's a new publication out there, Publication 17, that would be very helpful if you have questions on personal income tax information. And so look at that as well. And so that's really where we are. And looking ahead, again, we have our February webcast. I'm excited that one of our tax seniors at Capen and Krause, Ashley Peabody, is going to help me present that. And we're going to give you some do's and don'ts for ministers on preparing tax returns, and should be a really neat session. So we'll look forward to that. And we're hoping to be able to present webinars. It's not set in stone yet, so don't hold me to it, but we're hoping to be able to get out a webinar on it for individuals either in late October, early November, maybe even December, that would allow you to make some tax planning changes before the end of the year. So we'll look at that, and again, continue to look for future webinars. We're looking forward to wanting to help you understand tax issues and to be able to do well and really monitor that area of your life effectively. And I don't see any questions. I so apologize. There should have been a question format for you in the online thing. I don't see any that come into my email. There will be we're recording this, and hopefully we will have this on the American Anglican website within probably, I would say, a week, and it'll be there. The PowerPoint of this presentation will be there for you as well. And if you have any questions, general questions, go ahead and send those to my email. The contact is at the end of this presentation. And if you have very specific questions that are related to your personal tax situation, it's very difficult for us to answer those, but we'll do our best on generic questions to answer those or point you in a direction that will give you the information that you need. And please understand that any communication here is not intended to be used and cannot be used for the purpose of avoiding penalties and the such. Please consult your tax advisor regarding any information communicated via this webinar. And God bless you. I think that takes up our entire hour. And again, I appreciate the time to be able to be with you today. God bless you, and we'll see you in February.